This is a story about one of the worst money managers of modern times, who is also one of the greatest saleswomen I have ever seen. She has managed to accumulate a personal net worth of about $250 million, while destroying billions and billions and billions of dollars in investor money. But what's most amazing to me is she's still managing about $14 billion in other people's money, which means her small company is still raking in about $105 million a year in fees. What? Her name is Cathie Wood. Cathie Wood is one of America's most famous stock fund managers, or infamous, depending on how you choose to view her. Cathie Wood founded and runs a family of investment funds called ARK Invest. Cathie launched her flagship ARK Innovation Fund in 2014 with the mission of investing in innovation, which she defines as emerging life-transforming technology companies with the goal of finding the next Google, the next Amazon, or Microsoft, Apple, Tesla, or NVIDIA. In the first 2 years of her fund's existence, it didn't do much, lost 2% of its value, while the NASDAQ 100 index of mostly big tech stocks gained 13% during this same period. So the media wasn't noticing Cathie Wood much during this period. But then her fund took off. From November 1 of 2016 to February 12th of 2021, Cathie Wood's fund gained an astonishing 713%. 713% in less than 5 years. And Cathie Wood became a rock star in the financial media. She was celebrated as a financial genius.
What we think is not well understood is exponential growth.
You're having one of the best years in the history of professional money management. What's it like?
Oh, it's been unbelievable. Our portfolios are all about solving problems. Our investors have been rewarded for helping to solve some of the world's most profound problems.
What about on a personal level? Are you enjoying the celebrity?
I love what I'm doing. That's the first thing. I love the team I'm working with. I love our research. I love bringing to life new ways of looking at the world, helping people understand, how the world's going to change, and not only in their investment portfolios, but also in their own lives, their children's lives, their grandchildren's lives, helping them understand how to move everyone to the right side of change and really benefit from the exponential growth trajectories that are just taking off now.
It's okay to enjoy being a rock star.
Contributing to her celebrity status in the financial media was her prediction in 2019 that Tesla's stock price would hit $4,000 within 5 years. Tesla was trading at $333 at that time, so that would be a 12-fold increase in Tesla's stock price in just 5 years. And here she is in April of 2019 defending her $4,000 price prediction for Tesla's stock.
You've got a $4,000 price target, Cathie. Why is it that this is your top holding in your fund?
Well, it's the most misunderstood stock, I believe, out there, much like Amazon was in the day. This is very reminiscent of Amazon.
Your $4,000 price target, that's not a 12-month price target, right?
No, our time horizon is a 5-year time horizon.
And here she is on CNBC being mocked for her $4,000 price prediction for Tesla stock.
During the commercial break, we were mentioning that there's a Tesla now in space.
Yes.
You like Tesla?
Love Tesla. It's one of our largest holdings, largest in our overall fund.
But in the Tesla story, and we also keep looking at that stock with one big question. If it walks and talks like a car, it must be a car. And so it has 4 wheels, it drives around. All cars will be automated with AI eventually. GM will. Everybody else trades at a 15 to 16 multiple. They trade as if every car is being shot to the sun at some stratospheric number.
Yeah.
Which happens first? All GM goes to a 300 PE, or Tesla goes back to 16? Because one of those two has to happen.
No.
And here's what happened. Adjusted for stock splits, Cathie's $4,000 price prediction for Tesla stock came true. Not in 5 years, but within 2 years. She looked like a clairvoyant, a financial genius, especially since Tesla's stock price had done almost nothing for the previous 5 years when she was making this prediction.
You have gone from being a relatively unknown investor to one of the most successful and well-known fund managers in the world. I don't know if you know, but your face is now sold on t-shirts on Etsy.
And Cathie's $4,000 price target for Tesla within 5 years was actually her base case. In February of 2020, Cathie said that Tesla's stock price could go as high as $15,000 within 4 years.
Next guest thinks Tesla has room to run. In fact, she thinks Tesla could hit $15,000 a share within the next 4 years. Cathie, welcome. I know $15,000 a share is not your base case.
No.
It's your reach case. What is your base case of where this $700 stock is in 4 years?
Yes, the base case, it's the end of 24, it's $7,000.
So this was a period, 2020 to early 2021, when CNBC was hanging on every word that Cathie Wood uttered. And she was everywhere. And then the inevitable happened. Starting from its peak in February of 2021, Cathie's flagship ARK fund dropped 80% over the next 18 months. And this means her fund would have to gain 400% from there to get back to where it was 18 months earlier.
Just gonna stand there and watch me burn. But that's alright because I like the way it hurts.
And her fund still hasn't recovered much. It's still down 70% from where it was in February of 2021. It's now 2024. Now, it's true that the rest of the stock market dropped too. The tech-heavy NASDAQ 100, which is the 100 biggest, mostly tech companies, did drop 33% from November of 2021 to December of 2022. But the NASDAQ 100 came back. Not only has the NASDAQ 100 regained the 33% decline from its peak to trough, it's up 17% since its earlier peak in November of 2021. Cathie's ARK fund is still down 70% from its peak in February of 2021. And her fund just continues to pretty much flatline even while the rest of the major stock market indexes are near new record highs. And if we compare the 5-year returns of Cathie Wood's ARK fund to the NASDAQ 100 index and the S&P 500 index, Cathie Wood has returned just 2% to her investors over 5 years, compared to a 154% return her investors would have seen just by investing in the NASDAQ 100 index, ticker symbol QQQ. Or a 92% return simply by investing in an S&P 500 index, such as SPY. And you would have seen these much bigger returns, these exponentially bigger returns with much less volatility and much less risk than experienced by Cathie Wood's investors who saw only a 2% return over 5 years with stomach-churning risk and volatility. According to the investment research service Morningstar, Cathie Wood's flagship fund destroyed $7.1 billion in wealth over the last 10 years, which includes her huge 713% run up here. And she has another fund focused on health that destroyed another $4.6 billion in value, according to Morningstar. Morningstar is the gold standard for research on stocks, mutual funds, ETFs, and other publicly traded investments. Morningstar says Cathie Wood's flagship fund, ARK, is the, quote, third biggest wealth destroyer among all equity funds it has covered over the last 10 years. And there are thousands of stock funds you can invest in. And she's turned in the third worst performance, according to Morningstar. As Morningstar concludes, Cathie Wood over the last 2 years has, quote, managed to lose value for shareholders even during a generally bullish market, end quote, referring to the period from mid-June 2022 to October of 2023, or even until now. Yet she has piled up an estimated personal net worth of $250 million while doing this from the fees she charges. That's what I call failing your way to success, which is a big theme, by the way, of my new book, Win Life, Success Skills Schools Don't Teach. It's also a superb example of fake it until you make it. Or, in the land of the blind, the one-eyed man is king. Or in this case, queen. Now, since Cathie was flying high in 2021, assets under Cathie's management at ARK Invest have dropped from $58 billion to about $14 billion. Cathie's investors are sure hurting, but Cathie herself is doing fine. Cathie charges an annual management fee of 0.75% for assets under management, which is about $75 per year for every $10,000 invested with her. And this, by the way, is triple the yearly 0.25% management fee that the QQQ NASDAQ 100 Index Fund charges, which is $25 for each $10,000 you invest with the QQQ. When Cathie was managing $58 billion at her fund's peak in 2021, Cathie's company was raking in about $435 million in annual fees. But even with her assets under management slipping to about $14 billion, her company is still raking in about $105 million per year in fees. Yes, she has about 45 employees she has to pay, plus overhead, but this still leaves plenty of money for her. It's also important to note that most of Cathie Wood's investors bought her fund here, during peak media hype, not back here. The lucky ones were able to eke out a 2% return, if they got in back here. But most of her investors got in here at peak FOMO, peak of media hype and fear of missing out. That's what FOMO stands for. And FOMO is a phenomenon that happens in every asset appreciation bubble. Media hype begins here and here and here. Retail investors pile in here just before the blow-off top, and retail investors become roadkill. Now, this is not meant to be a video about trashing Cathie Wood, because actually there's a lot I admire about her. There's a lot we can learn from Cathie Wood about how to sell, about marketing, creating a narrative, and building hype and buzz around what you're selling. She's among the best at this. We will also learn from Cathie Wood's disastrous failure as a money manager how not to invest. She didn't pay the price for this. Her investors did. And by the way, nothing I say here should be taken as personal financial advice. I am not a financial advisor. As we go along here, I'll be talking about what I do and my own investing approach, but my investment style is probably not right for you. Consult your own financial advisor. Investment and money management approaches vary depending on your own individual circumstances, your age, your risk tolerance, and other factors. But one thing you can know pretty much for sure, do not follow Cathie Wood's investment advice or approach, but do emulate her sales, marketing, and PR skills. Cathie grew up in Los Angeles and graduated from the University of Southern California with a Bachelor of Science degree in finance and economics. She was a very good student. She graduated summa cum laude, which is with highest honors. She has no advanced degree, but she was a student of the famed supply-side economist Art Laffer, who became her mentor. Art Laffer was the architect of President Reagan's economic program of tax cuts and deregulation that produced the Reagan economic boom that really lasted about 25 years. I'm a big fan of Art Laffer. As a student at Dartmouth, I brought Art Laffer to the Dartmouth campus to speak in 1980. So Cathie and I share most of the same macroeconomic views and philosophy. I also agree with her overall theme of the transformative nature of technology. I'm a tech investor. My stock investments are 100% tech. Big tech, not small tech, for reasons that I'll get into in a bit. While she was still a student at USC, Art Laffer helped Cathie land her first job as an assistant economist at the Capital Group, which was one of America's biggest investment companies in the early 1980s, with tens of billions of dollars under management. She went on from there to work at Jennison Associates, where she was the company's chief economist at the age of 25. And while there, she met Lulu Wang. Lulu Wang is a very interesting character too. Not much is known about Lulu Wang. She's very private. She was born in Shanghai, China. Her family escaped from China just before Mao took over. She and her family arrived in America with nothing in 1948. She didn't know one word of English, graduated from Wesley College with a degree in liberal arts, and she started adulthood as a housewife. But she was drawn to the world of investing and Wall Street. She started as a writer for a small brokerage firm and ultimately arrived at Jennison, where she met Cathie. Along the way, Lulu earned an MBA at Columbia Business School. Lulu rose to executive vice president at Jennison, managing more than $4 billion in assets. Cathie and Lulu Wang left Jennison in 1998 to launch a hedge fund called Tupelo Capital, which in 2000 had $800 million under management, focusing on what Cathie called global thematic strategies. Cathie left Lulu Wang in 2001 to join a big investment house called AllianceBernstein, and Lulu kept building Tupelo Capital. Lulu does not disclose the performance of her hedge fund publicly, but she makes donations in the $50 million range to educational institutions and things that she supports. And she sits on the board of big companies such as MetLife. Lulu has done very well, to say the least. Cathie spent 12 years at AllianceBernstein as Chief Investment Officer of Global Thematic Strategies. Cathie managed more than $5 billion in assets at Bernstein. According to some reports, there was some uneasiness at Bernstein with Cathie's investing style. She had great years and horrible years. Her portfolio was a roller coaster of volatility, and some clients were complaining and heading for the exit. Reportedly, the leadership at Bernstein wanted Cathie to put some more stability in her portfolio, such as some indexes, just to make clients less jittery. And the precise reason for why she left Bernstein is unclear. but she departed to launch her own family of funds in 2014. Cathie is a strong Christian, so she named her family of funds ARK Invest, after the Ark of the Covenant. And Cathie is able to attract investors because she has a winsome personality and a very good sales pitch. Here's Cathie speaking in 2019, and this was her basic sales pitch. And I'll link to it below if you want to listen to the whole thing.
Innovation platforms. What do we consider an innovation platform? We center our research on something called Wright's Law. Wright's Law is, and you'll get this sense of exponential growth here, Wright's Law says that for every cumulative doubling in units produced, costs decline at a consistent rate. Mr. Wright derived this formula during the early days of airplane manufacturing. And he noticed for every cumulative doubling in the number of airplanes produced, costs declined at a consistent rate. When costs decline at a consistent rate, prices come down and unleash waves of demand. That's what we're talking about when we talk about exponential growth. You can see in the middle panel here, that's electricity, the start of electricity, and you can see how quickly it spread throughout the manufacturing sector. So innovation platforms are characterized by declining cost curves. They cut across economic sectors, cut across the world. And the third characteristic is they spawn more innovation. So the innovation platforms that are evolving today, you can see on the right there. We are publishing a paper this week on this chart. And what we're trying to communicate here is we have never been in a period of innovation like we are now. If we were measuring this on the Richter scale in terms of impact on the global economy, this would be a 9 compared to maybe a 5 or 6 in the late 1800s, early 1900s. So you can see you have to look back that far to the late 1800s, early 1900s to see multiple innovation platforms evolving at the same time. So back then, as I mentioned, telephone, electricity, internal combustion engine. Today, we have blockchain technology, deep learning, robotics, energy storage, and artificial intelligence. These innovation platforms are going to impact every sector and are traveling around the world very, very quickly. So they're going to transform every company and every industry. Here, you can see the 5 innovation platforms are the biggest bubbles on this chart. But there are other technologies. Each of the 5 is going to be multiple $1 trillion of market cap, we believe, in the financial markets during the next 5 to 10 years.
So Cathie says here that the world is undergoing the biggest technological transformation in history, with the 5 transformational technology areas being 1, blockchain technology. I disagree with this, by the way. I'm a Bitcoin holder. I wrote a book on Bitcoin. There's nothing revolutionary in blockchain by itself. Blockchain's been around since 1993. More on this later. I am a believer in Bitcoin. So blockchain technology, she says, is one of the transformational platforms. Number 2 is gene editing and sequencing, or genomics. Number 3 is robotics. Number 4 is energy storage. Number 5 is artificial intelligence. Cathie says that the last period of massive innovation was the late 1800s to the early 1900s. The innovations back then were electricity, the telephone, and the internal combustion engine. Cathie rates what was happening then as a 5 compared to what's happening now as a 9 in terms of transformational impact of the technological innovation that was going on. So Cathie believes that the technological revolution that we're seeing now dwarfs the technological revolution of the late 1800s, early 1900s in terms of transformation of society. Not sure I buy that. For thousands of years, life looked pretty much about the same, an agrarian society and economy. Then, boom, over an 80-year period, electric power, the telephone, cars, airplanes, landing on the moon. Not sure the advances we're seeing now are anything close to the transformation that we saw between 1890 and 1970. But I do agree with Cathie's overall thesis, which is the exponential financial returns we can see from investing in disruptive technology growth companies, which is why I am a tech investor. And I do agree with her that the age of computers, microchips, the internet, and now the dawn of AI is a period of tremendous transformation. The problem is picking the right companies. By 1900, it was obvious that the automobile would replace the horse and buggy. There was an explosion of automakers. Henry Ford rolled out his Model T in 1908. Early in the 20th century, we had 1,900 car makers in the United States. And interestingly, electric cars made up 1/3 of the cars on the road in the early 1900s. We also had cars powered by steam, most famously the Stanley steamer. But over time, the car industry in the United States whittled down to the big three: GM, Ford, and Chrysler, now Stellantis, plus Tesla in recent years for electric vehicles. And this is the pattern with every technology. There's an explosion of startups and massive competition. Then it whittles down to the few dominant players. In the 1990s, everyone saw that the internet was going to be enormously important.
What is internet anyway? What do you write to it like mail?
No, a lot of people use it and communicate. I guess they can communicate with NBC writers and producers. Allison, can you explain what internet is?
No, she can't say anything in 10 seconds or less.
Oh. I'm afraid that if I subscribed to something like internet, you would really be hooked. I would get hooked and I would never, spend time with my family.
Just what is this main artery of the information superhighway?
Every business, no matter how large, and no matter how small, will be on the internet in the year 2000.
Are a lot of people just getting on to the internet because they feel that they have to get onto the playing field, so to speak?
Well, it's very hip to be on the internet right now.
Then we had the dot-com boom in the late 1990s and bust in 2000, when the tech-heavy NASDAQ 100 lost 78% of its value. Thousands of internet companies started up in the 1990s. And some of the most famous dot-com era bubble disasters include Pets.com, that burned through $147 million in the first 9 months of 2000 before going out of business. A grocery delivery business called Webvan that raised $375 million in investment capital had a stock market value of $1.2 billion with 2,000 employees at its peak in 2000 before going out of business in July of 2001. The list of dot-com and tech startup flops goes on. And then there were the great companies that were buried in the rubble that would emerge as dominant: Microsoft, Apple, Google, Amazon, and the top semiconductor makers. Intel was dominant in semiconductors, but has faded to number 15 on the list of semiconductor companies in terms of market value because of poor management. NVIDIA is now the number 1 semiconductor in the world, triple the size of its nearest competitor in terms of market value. Identifying which tech companies would emerge as the winners is always the challenge. eBay was the dominant e-commerce site in the late 1990s and early 2000s, but ultimately lost the battle to Amazon. But even Amazon's stock price crashed 90% during the dot-com crash of 2000-2001. Investors were not at all sure that Amazon would win the e-commerce battle, or even stay in business. Everyone could see that the internet would be big. Picking the winners among the thousands of tech startups is always the problem. If this were easy, we'd all be rich, right? So here's Cathie Wood in April of 2022, after her fund had crashed 65%, telling her investors to just be patient. Her investments, her stock picks, her fund will come back, she promised, predicting 50% yearly compounded returns over the ensuing 5 years. That was her prediction.
It's been a rough 12 months for you, Cathie. You've been down 45% on your flagship ARK Invest. Can you explain to the viewers and to your loyal fan base, why should they continue to stick with you when you're down 45% on the year?
Well, I think if we put in perspective what has happened here, people believe averaging down into a strategy of ours, believing that we're onto something, some very big exponential growth opportunities. COVID, we got killed going into COVID, and our mantra was innovation solves problems. From the trough in COVID to the peak, we were up 360%. Prices have come down, but our models actually, our earnings return expectations have actually gone up. So over the next 5 years, we're expecting, consider the source, it's our research. Our research, I think, is the best in the business, but we're expecting a 50% compound annual rate of return.
Unfortunately, her fund kept crashing, dropped another 47% from there. Now, I'm very much a tech investor, but I take the opposite approach from Cathie. What I like to invest in the world of tech is monopolies or near monopolies. Technology tends to trend toward monopoly or near monopoly. So I invest in big tech, not early stage tech. The problem with investing in startup tech and early stage tech is that among the very low percentage of companies that do succeed, well, they just get bought by the big tech companies. Instagram and WhatsApp just get bought by Facebook, for example. Microsoft bought LinkedIn, Skype, Activision Blizzard, GitHub, and so on. So if you happen to guess right with your investment in an early stage tech company, and if that company works, Well, it's just going to get bought up by one of the big tech companies, probably for a 15% premium over the market stock price. So you'll get a 15% pop in your stock price. But that 15% pop does not justify the risk that you took investing in that early stage tech company. That's why I only invest in tech monopolies or near monopolies. I invest in the leader in the space, or perhaps in the top 2 in the space if it's close. I also invest in 2 big tech indexes, the tech-heavy NASDAQ 100, ticker symbol QQQ, the triple Q, and the SOX, SOXX, which is an index of the 32 biggest semiconductor companies. The reason I like to invest in the indexes of the biggest tech companies is because any company that makes it onto one of these indexes must have a good business model. Plus, companies are coming onto these indexes and dropping off these indexes all the time. The weaker companies drop off. Stronger companies are added and then rise on the index. So there's a built-in screening and weighting mechanism. The composition of the NASDAQ 100 today is very different from the companies on the NASDAQ 100 in 2000. Same with the S&P 500 index of the 500 biggest companies traded on U.S. stock exchanges. If I'm investing in an index of the biggest companies, whether it's the 100 biggest mostly tech companies on the NASDAQ 100, or the 500 biggest companies on U.S. stock exchanges, or the top 32 semiconductor companies, I really don't have to do much analysis. I just let the index do the sorting and the weighting. I let the market decide. But I don't like investing in total market indexes because, well, that's the total market. No screening mechanism like the NASDAQ 100 index, which is the 100 biggest companies on the NASDAQ. Then I also invest in a few individual companies that I have a strong conviction about and that are leaders in their spaces. And I do this really more as a game to see if I can beat the indexes that I'm targeting by a few points. The index that I'm trying to beat by a few points with my individual stock investment is the tech-heavy NASDAQ 100. And I've been doing this for many years and decades, and let me tell you, it's very difficult to beat the NASDAQ 100 over the long term. It's very difficult to outsmart the market. So I let the market tell me what to invest in. The market is a lot smarter than I am. The market is like a giant supercomputer with millions and billions of brains and making decisions every minute of every day based on data and market signals. And I'm just one brain participating in this with my very limited perspective. So for 99% of people, I like index investing, like the NASDAQ 100, QQQ, or the S&P 500, ticker symbol SPY or SPY. For me, I also like the SOX semiconductor index of the 32 biggest semiconductor companies. It's sector specific, so it has a lot of volatility. The SOX semiconductor index has beaten the NASDAQ 100 over the last 5 years and the last 10 years, but it has a lot of volatility. Over the last 5 years, the NASDAQ 100 has returned about 150%, the S&P 500 index has returned 89%, and the SOX semiconductor index has returned 224%. Then you add in dividends to these returns. Your dividends will be bigger for the S&P 500, currently about 1.3% per year. So add that to your annual returns from the S&P 500 index fund. The reason I like the SOX semiconductor index is because of my belief that the world will always need more semiconductors and faster semiconductors. We never have enough semiconductors. So that's my thesis there. And my biggest single stock investment, individual stock investment outside of the index, is NVIDIA, which is the biggest and most dominant semiconductor company. NVIDIA has a near monopoly for the kinds of chips that are needed for artificial intelligence. And I put my list of stock holdings here in order of size of my position so that you can see them. Again, don't copy me. Consult with your own financial advisor. I have a much higher risk tolerance than most people. I also hold 10% of my assets in Bitcoin for reasons that I'll get into in a bit. And 50% of my assets are in real estate, rental properties. So we're well diversified in terms of assets. Diversification is the key to wealth preservation and sleeping well at night, in my opinion. I believe in Warren Buffett's #1 rule for investing. Don't lose all or almost all of your money by doing something really stupid. Protect and preserve your capital. And Warren Buffett is the greatest stock investor of all time. In terms of the stock market, 88% of active money managers cannot beat the market benchmark index they are targeting over a 15-year period, according to the S&P Global Index versus Active Scorecard. 99% of people are just best off investing in an S&P 500 index fund, ticker symbol SPY, SPY, and or a NASDAQ 100 index fund, ticker symbol QQQ, or the triple Q. Or split your stock investments between these two index funds. That's what I tell my kids to do. Take 10% of your pre-tax income every paycheck and split it between these two index funds. Then forget about it and focus on generating personal income for yourself so that you can keep doing this every paycheck. That's how you get rich over time, not by letting Cathie Wood invest your money. Now, I don't disagree with all of Cathie Wood's investments. Tesla, for example. I do like Tesla as an investment. That's my 5th biggest individual stock holding. And Tesla does combine 3 out of 5 of Cathie's disruptive technologies that she talks about. Tesla combines robotics, artificial intelligence for full self-driving, and energy storage. Tesla is a leader in all 3. I also invest in Tesla because I'm a big fan of Elon. I think he's a combo of Thomas Edison and Henry Ford. As a private individual, he has the world's biggest space program. He and his team invented reusable rockets. So my investment in Tesla is an investment in Elon. And Tesla is a real business generating real profits. We can argue about whether the valuation is justified. It's growing steadily. I do think Tesla's valuation is justified only if it can solve true full self-driving, which will give us robotaxis. And I do think Elon will solve full self-driving. We will see. So I agree with Cathie on Tesla, which also fits her criteria of disruptive, innovative technology. Let's look at some of Cathie's other investments here. On her list, curiously, is Meta, which is Facebook. I don't consider Facebook disruptive, innovative technology. It might be a sound investment because social media is addictive, and it often makes sense to invest in companies that sell addictive products, such as tobacco and alcohol companies. But I don't think at this stage that there is anything innovative about Facebook. Facebook might be a perfectly good investment. It tracks pretty closely with the NASDAQ 100 index, but I just don't think Facebook is a good product anymore. I spend hardly any time on Facebook. I would just rather invest in the NASDAQ 100 QQQ index than in Facebook. Almost the same return without the risk of being in one stock. So Facebook doesn't seem to fit Cathie Wood's criteria of innovative, disruptive technology. And I'm not sure why Facebook is in her innovation portfolio of cutting-edge technological revolution. And she markets her fund as exposure to stocks that are not part of the benchmark indexes, not part of the NASDAQ 100 or S&P 500.
After the tech and telecom bust, and then even more so after 08, 09, I began to see just incredible risk aversion, career risk, business risk, and everybody was worshiping the almighty index benchmarks. And that was not consistent with what we were doing at all. So we were becoming, I describe it as an otter duck.
What she says she's trying to do is find the undiscovered diamonds in the rough. The next Google, Microsoft, Amazon, Apple, the next NVIDIA, the next Tesla. And also, other stocks in her portfolio on her list here make no sense by her own criteria. For example, her biggest holding is Coinbase. Coinbase is a crypto exchange. There's nothing at all innovative about an exchange. Coinbase is no different from E-Trade. Just except for being an exchange for stocks, bonds, and traditional financial assets, Coinbase specializes in crypto assets. But there's nothing innovative about an exchange. How has Coinbase done? Well, since its initial public stock offering in April of 2021, it's down 56%. Now, I am a holder of Bitcoin. I'm a big believer in it. Wrote a book about Bitcoin. Bitcoin is the only crypto asset I hold. Bitcoin is what's special, not a crypto exchange. Bitcoin is the first and only successful decentralized digital money. There will never be more than 21 million Bitcoins. It's now a $1 trillion asset with 400 million users worldwide. Bitcoin is not owned or controlled by anyone or any small group. And one of the surest ways to lose your Bitcoin is to keep it on an exchange like Coinbase. Not your keys, not your Bitcoin is the rule. You want to self-custody your Bitcoin. That's really the whole point of Bitcoin, to be your own bank. Bitcoin is unconfiscatable money if you self-custody your Bitcoin. Wanda and I have about 10% of our assets in Bitcoin. Bitcoin allows us to escape with at least a portion of our assets if America becomes a communist dictatorship, which I think is a real possibility. Bitcoin is the Second Amendment for your money. Bitcoin is insurance against economic and political system collapse. Bitcoin is the disruptive technology, not Coinbase. Cathie also says blockchain is one of her 5 disruptive technology innovation platforms on the level of artificial intelligence. But actually, blockchain is not especially innovative or disruptive. Blockchain's been around for a long time, since the early 1990s. Blockchain is used to secure data through the use of cryptography, which was developed by the National Security Agency in 1993 to secure America's military computer networks. What's innovative is Bitcoin's use of this technology to create the world's only automated, decentralized digital money, not under the control of humans. That's what's disruptive and innovative, not blockchain, and certainly not Coinbase. Cathie does say she has 25% of her personal assets in Bitcoin, which seems like a high allocation to me. Bitcoin is very volatile, so I agree with Cathie on Bitcoin, disagree on Coinbase. Nothing innovative about a crypto exchange, and Coinbase has been a terrible investment for her investors, and nothing new or innovative about blockchain. What's innovative is Bitcoin, which utilizes blockchain as an element of its genius structure. And I've written an entire book on Bitcoin here. I don't think Cathie knows what she's talking about when it comes to Bitcoin or blockchain, but I'm glad she's on board with Bitcoin. How about her number 3 pick, Roku? Roku is a streaming service. Nothing innovative about this. Roku's been around since 2002. Its IPO was in 2017. And Roku has been a terrible investment for Cathie's customers, down 55% over the past 5 years, while the NASDAQ 100 is up 150% over the same period. Netflix won the streaming battle. I do own Netflix because my approach is to invest in the industry leader. Remember, tech tends toward monopoly. But Netflix has been around a long time too now, and there's a lot of competition now in the streaming space. There's Amazon, Disney, Hulu, YouTube, and many others. And my Netflix investment has done okay, up 138% over the last 5 years, but not as well as the NASDAQ 100 index, which is up 150% in the same period. My Netflix investment has done very well since I started buying it in 2012, up 2,000%. But it's a pretty mature business now, no longer especially revolutionary or innovative. I'll probably sell my Netflix stock and just put that money into the QQQ and SOX indexes. So Roku, Cathie's 3rd biggest holding, is not innovative and has been a terrible investment, down 55% over the last 5 years. I see no compelling reason why Roku will come back. I won't go through all of her stocks here on our list of 35, but here we have Robinhood, which is just a stock exchange, no different from E-Trade. Nothing innovative whatsoever about Robinhood. How has Robinhood done? Well, Robinhood's initial public stock offering was in July of 2021. It's down 42%. It's come off its lows, but it's still way down during a period when the NASDAQ 100 index is up 38%. The only feature that was innovative about Robinhood was it eliminated fees on trades, no-fee trading. And this attracted a lot of day traders and helped fuel the meme stock bubble in the summer of 2021. Exactly the time when Robinhood issued its public stock offering. But then the other trading platforms like E-Trade just followed suit and also offered no-fee trading. By the way, there's no such thing as no-fee trading. There are the public fees, and then there are the hidden fees. The publicly disclosed $9 per trade fee that E-Trade used to charge is just a small part of their overall fee structure. So there's nothing at all innovative about Robinhood. And this has been, predictably, a terrible investment for Cathie Wood's investors. Here at number 12 on Cathie Wood's list of holdings is DraftKings. This is just online gambling. It's an online sports book plus fantasy football. Nothing innovative about DraftKings. But it's actually done pretty well for Cathie as an investment, up 252% since its IPO in 2019, even though the company has no earnings, no profits. But it's growing pretty rapidly in terms of gross revenues, so maybe it will turn a profit at some point. So DraftKings is doing well for Cathie, but online gambling is certainly not innovative. Its market cap is pretty small, $16 billion. Smaller cap stocks are subject to price manipulation and can easily be pumped, dumped, rug pulled, and crushed by the big boys. I would want nothing to do with DraftKings. And this is another reason why I don't like small cap stocks. Price manipulation by the big boys is super easy with small cap stocks. And that's another reason why I like stock index funds like the QQQ, SPY, and the SOX. Harder for the big hedge funds to manipulate prices on the big index funds. So I stay away from small cap. 95% of small cap will be gone soon, or will always be struggling. Very few will amount to much. The odds of finding the next Google among the thousands of small cap tech companies is just about zero. Like looking for a needle in a haystack. Tech marketing guru Seth Godin told me in 1999 to invest in Amazon. Wish I had followed his advice. But to me it looked like an online bookseller. I just didn't see how you could make much money selling books online. Not a lot of profit margin in books. I didn't understand what Amazon founder Jeff Bezos was really doing. He was selling books so he could discover people's interests, so he could sell them other things, which is basic direct marketing strategy. And as a career direct marketer myself, I should have been able to see this. Even so, there was no guarantee in 1999 that Amazon would succeed. And indeed, Amazon's stock price did crash 90% in 2000-2001, and did not regain its December 1999 price peak until 2009. So it took 10 years for Amazon stock to recover from the 90% crash during the dot-com boom and bust. That's how tough it is to find the next Amazon. Hindsight is always 20/20, but even if you were to guess right and buy Amazon in 1997 when it went public, what are the odds you would hold it through all the volatility, including the 90% drop in stock price in 2000-2001? Pretty much zero. Because very few people have the stomach and the intestinal fortitude to be able to emotionally and psychologically withstand 90% drops in their stock investments. Almost surely you would sell during the 90% crash, probably near the bottom of the 90% crash. And 99% of stocks that crash 90% stay crashed and often go bankrupt. Plus, almost certainly you would have bought near the top, because that's when the stunning increase in stock price is getting all the media attention and all the coverage on CNBC. And you would have bought the stock right here, near the blow-off top, before the crash. And that's another reason to go with the indexes, QQQ and SPY, and not try to pick individual stocks, especially individual small company stocks. Small company stock investing is almost always death, unless you're really experienced or just lucky. Let me go through some more of Cathie Wood's stock picks. Her fourth biggest holding is Zoom Video. How's that done? Welp, not well. Zoom's stock price dropped 90% from its peak in October of 2020 and then just flatlined. I agree with Cathie that Zoom is a good video conferencing service with some good features, but there's nothing really innovative about Zoom. And there are a lot of competitors, such as Skype, which is owned by Microsoft now, Google Video, and many others. What was innovative was the COVID pandemic of 2020, which really helped the so-called stay-at-home tech stocks like Zoom Video. Businesses needed to function during the pandemic lockdowns when everyone was locked in their homes, so Zoom was a speculative stock that did well during this period. But once the pandemic panic was over and people started returning to the office, there wasn't as much need for Zoom. Zoom will continue to be used, of course, but there are many competitors. There's no moat around the business. Nothing about Zoom that can't easily be replicated, and that has been replicated and improved upon. I personally prefer Google Video. Microsoft Teams is also fine. They're all about the same. Teladoc is another stock hyped by Cathie. It's still number 13 on her list. It used to be higher on her list. Teladoc allows you to consult remotely with a doctor via video. Teladoc is basically Zoom calls with doctors. Cathie told us that Teladoc would do to healthcare what Amazon did to brick and mortar retail.
We're looking at one of the biggest stories in healthcare, a category killer during the next 5 to 10 years.
What do your analysts think Teladoc is worth per share? It is currently trading at 34.
As Simon Barnett, who is one of the most brilliant analysts out there in this space, he was adjusting his model and he said, I can't even throw out this number. We'll haircut it by 50%. He sees, again, preliminary estimates, a 10-fold increase. This is like Amazon. Remember Amazon in the day.
How has Teladoc done? Welp, it's down 87% over 5 years and down 97% from its peak in February of 2021. The fact that Cathie was hyping Teladoc as the next Amazon, but for healthcare, was yet another tell for me that Cathie had no clue what she was talking about in terms of investing. There was nothing revolutionary, innovative, or disruptive about Zoom-style video calls with doctors. Teladoc had been around since 2002. During the pandemic, Wanda and I were doing Zoom calls with our doctor. Nothing at all new here. Teladoc enjoyed a brief bubble in the stock market and surge in revenue during the pandemic when people had no choice but to see doctors remotely via video. But there's no substitute for in-person visits with your own doctor. Then there was the predictable catastrophic crash in Teladoc's stock price when the pandemic era ended. Revenues aren't growing and the company's never been profitable. Cathie describes herself as a thematic investor. She looks at big trends and themes, but doesn't do much hard analysis of individual companies. At the start of every year, Cathie and her team put out what she calls her annual Big Ideas Report. And basically what these reports do is just state what the total potential market is for an emerging technology. In investing, that's called total addressable market. So her Big Ideas Report for 2020 states that deep learning artificial intelligence will have 3 times more impact than the internet in terms of transforming life as we know it. She says the internet created roughly $10 trillion in global equity market value over the last 20 years. Deep learning AI, she says, will add $30 trillion to global equity markets over the next 2 decades. She bases this estimate on nothing. Maybe she's right, maybe she's wrong. And if she's right, so what? What does this mean for me or you as an investor? What specific companies should I invest in and why? And can you back up your recommendations with real numbers and real analysis of financial statements and balance sheets of specific companies? Cathie doesn't do any of this. She just talks in big themes and broad strokes in her annual Big Ideas reports. Everyone was pretty much saying the same thing about the internet in the 1990s. Everyone knew the internet would be big. Then we had the dot-com boom and bust. Thousands of dot-com companies went bust. A few emerged from the rubble to essentially become monopolies. Google, Microsoft, Amazon, Apple, the big semiconductor companies. Almost anyone can see the big macro trends and spot the big market opportunities. But which small handful of companies will be the winners among the thousands of competitors? That's the challenge. Another Big Ideas chapter was on drones. That's one of her big ideas. She predicted in 2020 that drones would become the new dominant method of food and package delivery, that food delivery by drone could be a $116 billion industry. Are you seeing a lot of food deliveries via drone yet?
When the drone has arrived at the customer's house, it begins to scan for a safe landing spot. We're unsure how this process works, but from videos it could work as one of 2 ways. This could involve the drone assessing a predetermined landing area, either set up by the customer or a mapping system, or a special mat could be placed down by the customer, which provides the drone with a reference point. The tech on this mat could be as simple as a color-coded symbol for the drone to read, or it could involve a QR code which confirms the correct location. For a more private experience, the mat may even use a combination of Bluetooth and ultra-wideband for pinpoint accuracy, although this would have to involve charging the mat between uses. It's safe to say we don't know at this point.
So far as I can tell, no one in our neighborhood has received a single food or package delivery by drone. Maybe that will happen. But Cathie's prediction here is in 2020. We're now in 2024. Cathie predicted in 2020 that we would soon be seeing electric air taxis. That's right, electric air taxis. Well, we're now 4 years later in 2024. What do you think the odds are of seeing electric air taxis anytime soon, even in the next 10 years? When I was 4 and 5 years old in 1962 and 1963, I used to love watching the cartoon The Jetsons. And I was certainly expecting to see flying cars long before now. Every decade I've been asking, where are the flying cars that we saw in The Jetsons? Why aren't we seeing flying cars? Wouldn't flying cars solve the road congestion problem? Well, hasn't happened so far. Not since The Jetsons came out in 1962. There must be reasons why flying cars aren't happening. It's not like the technology hasn't been around for a long time. Why does Cathie think this will happen anytime soon? And why does she think this is an investment opportunity? What companies should I invest in that are doing this, that are doing flying cars? We get no recommendations from her Big Ideas report on what flying electric taxi company we should be investing in, or what food delivery flying drone service we should invest in. What do their financials and balance sheets look like? What are their sales? It's just a big idea that Cathie and her team like to write and talk about. In her 2020 Big Ideas report, Cathie projects that unmanned robotaxis would be a $5 trillion industry by 2024, and a $9 trillion industry by 2029. And she believes Tesla will lead the way on this. So far, this isn't even close to happening. There have been a few very tightly controlled robotaxi tests in a few cities, like San Francisco, Phoenix, and a few others, conducted by Google's Waymo and GM's Cruise. So far, the results have been unsatisfactory to disastrous. Stranded and confused robotaxis cause traffic jams and have run into pedestrians.
Officers arrived and they found an autonomous car struck an adult, a female adult that is. No one was inside this Cruise car at the time of the accident. Now, SF Fire said that its crews had to secure that Cruise car to free the victim. That victim was rushed to the hospital with traumatic injuries.
There's like 1, 2, 3, 4 Cruise cars blocking. No one can get through.
Just one day after California approved the expanded use of driverless cars, nearly a dozen robotaxis froze, creating a traffic jam.
And I looked and there were no drivers in them.
Then, a New York Times report of one getting stuck in wet cement.
Look at this, guys.
And separately, a Cruise taxi collided with a fire truck last week, preventing it from responding to a fire.
The number of humans in the control room needed to supervise one robotaxi exceeds the number of people needed to supervise a traditional taxi cab, which is just one person, the driver. So far, robotaxis are not close to working on any acceptable level. And if we ever do get to a point where true AI-powered, full self-driving robotaxis with no need for human supervision is available, how long will it take for approval of robotaxis by government regulators? I am an investor in Tesla and a believer in Elon, but he promised we would have true full self-driving cars years ago. So far, hasn't achieved it. Maybe he's close. Hasn't happened yet. I'm still betting on Elon over the long term. But I'd be lying if I said I'm not concerned. I'd be lying if I said I'm fully convinced of Elon's ability to deliver a true full self-driving robo-taxi industry anytime soon. But one thing I do know for sure, robo-taxis will not be a $5 trillion industry by 2024, which is now. I'll be happy if we have a true full self-driving robo-industry by 2030 or 2035. Cathie Wood's pie-in-the-sky predictions are just a joke, almost a parody. And here in her Big Ideas report, she provides this little cartoon graphic where she charts the reduction of cost per mile, starting with a horse and buggy in 1871, with the cost per mile back then at $1.71. Autos cost 70 cents a mile. And she says robotaxis will cost 25 cents a mile. Well, yeah, that might be true. Technological advances always push costs down, but so far no true full self-driving, much less robotaxis. Okay, let's look some more at what Cathie Wood is doing. And now we're going to get into the real disasters. Her fifth biggest holding is a software AI company called UiPath. UiPath has been around since 2005. It makes software powered by AI that aims to automate repetitive office and clerical jobs, thus freeing up humans to do more creative work. The theory is that much office work is repetitive, such as data entry, accounting, human resources paperwork, and customer management. UiPath can read information from a screen or a document and enter that in. In theory, this would make many businesses much more efficient by letting the AI-powered software take over soul-destroying repetitive jobs and perform these tasks much faster, more efficiently, and without human error.
What if you had an AI companion that effortlessly handled your work alongside you? Introducing UiPath Autopilot for Assistant, your trusty work buddy that helps everyone from the CEOs to the interns automate their most tedious tasks. Meet Leah, a sales manager. She's just read that a major prospect is speaking at a conference in London, and it's a great opportunity to showcase her company's products. She asks Autopilot to help plan a trip. Autopilot starts organizing the trip according to the company guidelines and notifies Leah that she needs manager approval for trips within 2 weeks. Leah uploads her passport and Autopilot uses document understanding to extract relevant information. At Leah's request, Autopilot enters these details into Concur using UiPath AI automation. Autopilot knows she needs a business visa and helps create a ServiceNow ticket for her, attaching an employment verification letter from the HR system. Then, Autopilot uses a UiPath automation to set out-of-the-office messages in Outlook and Slack, making sure Leah is covered on all fronts. Lastly, Leah asks Autopilot for help preparing for this meeting. Autopilot dives into Salesforce, retrieves all relevant details, and sends a personalized message to the prospect on LinkedIn. And just like that, Leah is all set for her trip.
Well, that sounds awesome. In April of 2021, UiPath launched its initial public stock offering, raising $1.3 billion. How has the stock done since then? Welp, it's fallen 84% since its IPO in 2021. And there are no signs it's coming back. There are no profits. It's a long way from showing profitability. UiPath had $1.3 billion in sales over the last 12 months, but costs were $1.5 billion. In 2022, UiPath had $892 million in sales, but costs of $1.4 billion. In fiscal 2023, UiPath had sales of a little over $1 billion, but costs of $1.4 billion. UiPath is burning through money like crazy, largely because UiPath has deployed a massive sales force and is spending a lot on marketing and on research and development. UiPath reports spending $713 million on sales and marketing in fiscal year 2004 and $701 million in fiscal year 2023. UiPath also reports spending $332 million on research and development in fiscal year 2024 and $701 million on R&D in fiscal 2023. So that's $1 billion plus per year just on sales, marketing, and research and development. And UiPath has $938 million in liabilities, almost $1 billion in debt. The only way UiPath will stay in business is by issuing more stock, assuming it can find investors. But the real problem has been UiPath's product. UiPath's AI-powered software is glitchy. It doesn't work very well. It's expensive and time-consuming to set up. When the repetitive office task changes in any way, the software has to be set up again and reprogrammed by an expert. UiPath is forecasting sales for fiscal year 2025 at $1.4 billion, which is hardly any growth at all over the $1.3 billion in sales for the previous year. So no growth essentially, which is not good for a growth company that lost $520 million in fiscal year 2020, lost $92 million in 2021, lost $526 million in 2022, and lost $328 million in 2023. I mean, what the F? That's why UiPath's stock chart looks like this. Crash, then flatline. Ouch. Now, the idea of using AI-powered software to automate mundane, soul-destroying office tasks sounds great, but execution matters. Execution is everything in business. If you can execute, you actually don't have to do anything innovative. How innovative is Coca-Cola? Not innovative. And Coca-Cola makes money hand over fist. One of the richest people I know got rich selling gravel. Not innovative. I also think the hype around AI is overblown. Mostly a mirage. Google and Microsoft keep funneling me to their AI product to do searches and ask questions. But these products suck. I'm detecting no intelligence whatsoever. The answers that come back are often obviously wrong or not helpful at all. Traditional search engines with no AI are much better. And I'm not sure what they're calling AI actually is AI. So far, what they're calling AI is no good at all. And it's absurdly woke. Now, Elon is making non-woke AI for Grok. So far, it's no better than the other AI products out there. It's just not woke. So your questions, at least, aren't censored. Maybe AI will get better, but I think it's going to take a lot longer than people think. Look how long it's taking Tesla to deliver AI-powered, true full self-driving, unsupervised by humans. Elon promised this would happen years ago. Seems to be a lot harder than people thought. Maybe this will happen at some point. I'm betting it will happen at some point, but I'm going to bet on the big companies that are true leaders in AI already, that being Google, Microsoft, Elon, and NVIDIA. I don't know who the winners in AI will be. What I do believe is that we're always going to need more compute power for AI, faster and faster chips, more and more data storage. That's why I invest mostly in two big tech indexes, the QQQ, which is the NASDAQ 100, and the SOX Semiconductor Index, plus a few select single stocks, but leaders in their tech space. NVIDIA is by far the leader in terms of chips needed for AI. NVIDIA is basically a monopoly in that area. So in my view, a good way to invest in AI is to invest in semiconductor companies. AI also requires massive cloud data storage. NVIDIA is also a cloud data storage company, as are Google, Amazon, Microsoft, and Tesla. Other cloud companies I like are CrowdStrike, Cloudflare, and Pure Storage. This is the shovels and picks method of investing in AI. We don't know what AI products will work. Just like in the gold rush of 1849, we did not know which gold miners would find the gold. The winners in the gold rush were those who made and sold the picks, shovels, and mining equipment to the gold miners. So that's my thesis on how to make money in the AI gold rush going on now. Okay, let's look at some of Cathie Wood's most spectacular disasters. And those mostly involve early-stage gene editing, genomics research, and biotech companies. Cathie is especially interested in gene editing technology, as am I. If gene editing can be solved and approved by the regulators, the promise is we might be able to cure cancer and many other deadly diseases by editing out the genetic anomalies and defects. Might even be able to fix the aging problem, so we can live hundreds or thousands of years, like in the early part of the Bible. That would be awesome. But will this happen? And is gene editing investable? Let's look quickly at Cathie's Big Ideas report of 2020. She predicted gene editing and related activities in the field of genomics could add $9 trillion to the equity markets within 5 years. That was in 2020. Well, obviously that hasn't happened. The promise of biotech has been out there for a long time. And biotech really got hot in 2015, as we can see in the Biotech Index Fund here called XBI. XBI is the best-known biotech index fund. And you can see the big move up here in September of 2015 for the Biotech Index, when the promise of biotech was at a fevered pitch in the financial media. Starting with this big up move in September of 2015, we see a price increase of 319% for the ensuing 9 years, until now. And that's okay. Not quite as good as the 350% return we've seen from the good old NASDAQ 100 index, and not nearly as good as the more than 700% return we saw from the SOX semiconductor index during this same period. And the bio index is extremely volatile, so you get less return with more risk and more volatility. A big reason for this is that it can cost billions of dollars to bring a new drug to market. If you actually succeed in getting your drug or treatment to the FDA's Phase 1 trial, no easy feat, your odds of actually getting through all 5 phases of this approval gauntlet is less than 7.9%, according to the Bio report. And for drugs that are approved eventually, it takes them about 10 years on average to get approved, and usually billions of dollars. And because gene editing is so new and untested on humans, the cost of getting approval by the FDA for gene editing treatments is incalculable. So there's just no way I would invest in gene editing. Even though I assume it will work at some point and become enormously profitable for some in the distant future, I'm just not willing to wait that long. So let's take a look at how some of Cathie Wood's gene editing and genomics stock picks have done. Welp, her 7th biggest holding on her list of stocks is a gene editing company called CRISPR Therapeutics. How's it done? Well, it's up 3% in 5 years, so that's better than many of her stock picks. CRISPR is down 76% since its peak. Here's CRISPR's earnings chart. Just a sea of red year after year, and it's not like it's forecast to get any better. But the backstory behind CRISPR Therapeutics is really quite fascinating. The company was co-founded in 2013 by a female French scientist named Emmanuelle Carpentier, who won the Nobel Prize in 2020 along with her science partner Jennifer Doudna for their work pioneering gene editing technology. And the famed biographer Walter Isaacson has written a fascinating book about Jennifer Doudna and the gene editing project titled Codebreaker. Jennifer went on to found a competitor to CRISPR Therapeutics called Intellia, which Cathie's fund also invests in. Here it is at number 16 on Cathie's list. How has Intellia done? Well, it's up 55% over 5 years, so that's not too bad, though down 87% from its FOMO peak in September of 2021. I think these two women are absolutely awesome. They're brilliant, geniuses. I can see why Walter Isaacson and Cathie Wood are fascinated with the stories behind these women and the potential for gene editing to cure cancer and all kinds of deadly genetic diseases. The problem with investing in their companies is that they just lose boatloads of money year after year after year. Here's what the earnings look like in Jennifer's company, Intelia. Again, just a bloodbath of red in terms of losses year after year, and not forecast to get any better. This is the forecast area here. Now I'm sure these two genius ladies got rich because I'm sure investors love their story. And I hope they got rich because they're awesome. But these are not businesses, not at this point. They're a hope and a prayer. Another company in the genomic space that Cathie Wood was very high on was called Invitae. Invitae was once one of her top holdings.
Which one you think is the most underappreciated name right now in your portfolio that you'd be looking to add positions to?
Invitae in the molecular diagnostic space is probably one of the most important companies in the genomic revolution, and it is getting hammered. It's a company that has had historically small cash cushions, although they've rectified that with offerings, which is great. But it's investing aggressively to be the leader in the molecular diagnostic testing space.
The promise of Invitae was that you could send your blood off to Invitae, they would study your DNA, then they would tell you about potential diseases that you're vulnerable to, so that you could take preventative measures. So how is Invitae doing? Well, Invitae filed for Chapter 11 bankruptcy, and its stock is no longer listed on mainstream stock exchanges. And here's a history of Cathie's Invitae trades. Looks like she sold shares of Invitae here for 2 cents a share. Interestingly, look how much she sold it for right here, at the top for $56 a share. And she sold what must be the last of what she could sell down here for 2 cents a share. So it looks like she's still holding some Invitae stock that she could not sell. Ouch. It's a similar story for all her biotech picks. Here's PacBio, down 97% from its peak. Cathie was very high on PacBio. How about 10x Genomics, number 21 on Cathie's list? Down 55% over 5 years, down 88% from its peak. How about Recursion Pharmaceuticals? Down 76% from its IPO in 2021. How about Ceres Corporation? Number 31 on Cathie's list. What's Ceres Corp? Says it's dedicated solely to safeguarding the world's blood supply. Okay, that sounds good. Not sure if that's innovative or disruptive technology. How's the stock doing? Not well. It's down 57% over the last 5 years. And here's the company's lifetime stock chart since 1997. So if you had invested in the Ceres Corporation in 1997, you would have lost 81% of your money, not factoring in inflation. So really, more like 99% of your money gone if you factor in inflation. Why would Cathie think Ceres Corporation is a good investment? No history of success whatsoever. A 2-year-old can make smarter stock picks just by pointing randomly at stock listings. All of Cathie's biotech stock picks look similar in terms of their performance and stock charts. In fact, she has a fund dedicated to just genomics and biotech. How's that doing? Well, predictably even worse than her flagship ARC Innovation Fund. Here's her genomics fund. A 5-year return of minus 16%, compared to up 150% if you had just invested in the NASDAQ 100 index, the QQQ, during the same period. Cathie also has a space exploration fund called ARC-X. How's it doing? Well, predictably, not well. Down 26% from its launch in 2021, while the NASDAQ 100 index is up 41% in the same period. Cathie also has a fund that specializes in 3D printing. For decades, many have thought 3D printing would be the next big thing. 3D printing's been around since the 1980s. And 3D printing is a regular fixture in Cathie's annual Big Ideas reports. Here in 2020, she tells us that 3D printing is poised to grow from a $10 billion industry in 2018 to a $97 billion industry in 2024, and grow at a 65% compounded annual growth rate. How has Cathie's 3D printing fund done? Welp, she launched it in 2016, and it has a total return of 0.85%. So less than 1% return over 8 years, with plenty of volatility. Now 3D printing is pretty interesting, and I've looked at it closely. And here's why it's having trouble moving out of the hobby space to become truly useful in mass production manufacturing. To make metal parts using 3D printing requires the use of metal powder, and melting it all and fusing it all together by using lasers and electron beams. It takes a lot of time to complete each part, welding layer after layer of metal or metal powder until the part is complete. This is a very slow and much more costly process than traditional steel making and metal production. 3D printing can be useful for making prototypes, single copies of something, not good for mass production. It's very slow and costly. That's why the chart for Cathie's 3D printing fund looks like this. It looks exactly like the 3D printing industry, just bumping along, not doing much. Is there a future in 3D printing? I have no idea, but it's been around since the 1980s and hasn't done much so far. But I would not have wanted to be an investor here and ended up here when I simply could have invested in the NASDAQ 100 index, the QQQ, in 2016, at the time her fund started, and gotten a 360% return on my money instead of less than 1%. Cathie has many stock funds. I think I counted 18. So far as I can tell, they're all turning in similar performances. Cathie even has an Israel Innovative Technology Fund. How's that doing? Well, predictably, not well. Her Israel Technology Fund is down 1.76% for the last 5 years. Now, Israel is very good at technology. They're very smart people. But it's also a tiny country in the Middle East, surrounded by hostile Muslim countries and terrorist groups who hate Israel. Iran is constantly threatening to wipe Israel off the map. Israel is in a constant state of war with its neighbors. I like Israel, but I'm not going to invest in Israel. Cathie just doesn't seem to have much in the way of analytical abilities or skills. She's unable to evaluate risk in terms of stock investing.
We are a volatile strategy, right? And our response was, well, volatility on the upside is not a bad thing, right?
It took a lot to get people's attention because they thought we were too risky, too crazy. And I see now it's coming full circle because I hear that again, but it's much less risky than we believe the benchmarks are. The benchmarks are filling up with value traps because the innovation platforms, there are 5 of them, and they involve 14 different technologies that are all taking off right now. They are going to disrupt and disintermediate the traditional world order. So I think the big risk is in the benchmarks, not what we're doing.
Remember the Warren Buffett rule. Avoid big losses, because if your stocks drop 80%, that means they need to go up 400% just to break even. Cathie doesn't seem to understand this. It's not just the possible upside, it's about the risk you take to get this potential gain. This is called the Sharpe ratio, which can be expressed in mathematical terms this way. The market tends to revert to the mean of the trend over time. The Sharpe ratio divides a portfolio's excess returns by a measure of its volatility to assess risk-adjusted performance. Excess returns are those above an industry benchmark return. And the Sharpe ratio is named after the economist William Sharpe, who put this theory forward in 1964. The Sharpe ratio is far from perfect, but it's a good approximation of risk versus potential reward. Not sure Cathie knows about the Sharpe ratio. If your performance looks like this, Cathie Wood's fund on February 12, 2021, it's quite likely, almost certain, that her fund was going to end up looking, well, the way it did. So why did Cathie's fund go up so much during this period? Well, mostly she was just lucky short term. She happened to be holding many of the stocks that did well during the COVID pandemic stay-at-home era. She was holding the stay-at-home stocks like Zoom, Teladoc, Shopify, Square. Also holding healthcare and biotech stocks that were hot during the pandemic era, when people were focused on the pandemic and healthcare, big pharma, and biotech. She also made a good call on Tesla, her biggest holding at that time. It's now her number 2 biggest holding behind Coinbase. We also had an economic lockdown that fueled the overall tech stock bubble in 2020-2021. The U.S. government printed up trillions and trillions of dollars and just dumped that money on the population, just handed out to people, helicopter money showering from the sky. So people were locked in their homes, flush with COVID stimulus checks coming in each month. And people had really nothing to do with their time but watch TV or become stock pickers, become day traders.
I'm in here trying to make some money. My wife said I can't take the losses I had yesterday, which I basically, I basically lost everything we had. We took out a loan today. We got $10,000, so I'm going to try and turn that into a victory for us.
So anyone investing in the tech stock index like the NASDAQ 100 did well in 2020 through November of 2021. Tech stocks during that period outperformed all rationality. We also had the meme stock boom and bust with GameStop, and the AMC movie theater stock that went up 2,600% in 2021 in anticipation of the reopening. And we saw Cathie Wood's fund with her mostly garbage stocks shoot up 200% from just before the pandemic to February 12th of 2021, with 70% of the stocks that she was holding never having turned a profit. Whenever an asset shoots up in price that much that quickly with no reason to justify the geyser-like rise in prices, well, the predictable happens. Her investors got crushed, just like the meme stock investors in AMC and GameStop during the meme stock period. So she got lucky temporarily, that's all. Happened to be holding the right kinds of stocks in the midst of a once-in-a-lifetime event, the COVID pandemic. But it all turned into fool's gold for those who believed her declarations and fantastical predictions. Now let me dismantle Cathie Wood's approach to investing by simply using basic math. In December of 2022, Cathie explained in an article on her website why she believed her fund would come back and would reward investors who are patient and who stick with her. Her fund was down 80% from its peak at this point. In her article, Cathie acknowledges that only 5 of the 33 companies that she's holding in her portfolio were profitable according to GAAP-based EBITDA standards. GAAP stands for Generally Accepted Accounting Principles. And she shows a chart for GAAP-based EBITDA, which stands for Earnings Before Interest, Taxes, Depreciation, and Amortization. Now, Warren Buffett, the greatest investor of all time, says that EBITDA is a phony measure to begin with because the last time he checked, interest, taxes, and asset depreciation are costs. So 5 of Cathie's investments are profitable companies if we go by this GAAP-based EBITDA chart, which does not pass the Warren Buffett test for legit. And 28 out of 33 of her portfolio companies are losing money even by this metric. Her 2 most profitable companies are Tesla and Nvidia. And interestingly, she no longer holds Nvidia. She sold her Nvidia stock in the fall of 2023. And since she sold her Nvidia investment, Nvidia's stock has gone up like 140%. So she dumped her best holding. So 28 of Cathie's investments out of 33 are in companies that are not profitable, have never turned a profit, even according to this metric, the GAAP-based EBITDA standard, which Warren Buffett says is phony math. But it's not phony enough for Cathie. So she's come up with a new chart using new metrics developed by Cathie. And her new chart shows 26 of her companies profitable now, 7 still not profitable. Cathie is a master at sales, but she's not a numbers person, and apparently has no analytical skills whatsoever, at least when it comes to stock picking. And she explains that with this new chart that what she's doing is, first, she's adjusting research and development costs, or expenses, down to the average of the NASDAQ 100, which is 12%. The problem with this is that the average R&D cost for Cathie Wood's portfolio companies is 29%. Cathie argues that early-stage tech companies, especially AI and biotech companies, must spend a bigger share on research and development than mature companies that have established products. And the hope is that increased research and development spending will produce successful, marketable products sometime in the future. Okay, well, that's the hope. So that's the first problem. The second problem is that Cathie adjusts sales and marketing costs to the average for the NASDAQ 100 companies, which is 17.7%. But Cathie's portfolio companies spend an average of 33% on sales and marketing. Cathie argues that early-stage tech companies have to spend a lot on sales and marketing in order to get noticed and to gain market share and acquire new customers who will then, theoretically, generate revenue in the future. Well, yeah, that's pretty basic. You have to spend on sales and marketing to get customers. But here's the thing. Big established companies on the NASDAQ 100 have enormous profits that they can pour into sales and marketing to further gain market share. And they have a lot more money to spend on sales and marketing than what Cathie Wood's companies have, these early-stage tech companies and biotech companies that Cathie Wood has in her portfolio. The third problem is that Cathie also adjusts stock-based compensation to the average for the NASDAQ 100, which is 3.1%. But Cathie's portfolio companies spend an average of 23% of their revenue on stock-based compensation for managers and for employees. Cathie argues that this is necessary for early-stage companies so they can attract the top-level talent. Well, that is certainly true, But it's also a cost that you have to count. To compensate top executives' employees with stock, a company has to issue more stock, which dilutes the value of the stock held by investors. Now, I do like some stock-based compensation in order to align incentives for management and employees with the interests of shareholders. That's good. But absurd levels of stock-based compensation means that there's little money left over for shareholders. And by way of example, the chairman of Apple, Tim Cook, owns 0.021% of Apple. So there's plenty left for shareholders. And Tim Cook is still doing just fine. He's a multi-billionaire because Apple has done well under his leadership. Now, the fourth problem with Cathie's method here is that Cathie strips out impairment costs. An impairment cost is when the value of a non-cash asset on the company's balance sheet declines. One of Cathie's holdings is Teladoc, and it had to take a $13.4 billion impairment cost in 2022 because of poor performance of its acquisition of Livongo in 2020, whatever Livongo is. Then in 2024, Teladoc had to take another $790 million impairment cost due to poor performance of its BetterHelp acquisition. While one could argue that these impairment costs were just downgrades in goodwill as a company asset, not a real operational cash loss, it does mean Teladoc was inflating the value of these assets on its balance sheet. That's not good for trust. And partly as a result of this, Teladoc's stock chart looks like this, down 88% over 5 years. When the assets that you are claiming on your balance sheet go down by $14 billion via impairment costs, this makes it harder to raise capital because the assets you are claiming to have declined in value by $14 billion. Also in light of the fact that gross annual sales are just $2.3 billion. And Teladoc is already $2 billion in debt, and this company has never been profitable. Hence the dismal outlook for Teladoc. And remember that Cathie told us that Teladoc would do to traditional healthcare what Amazon did to brick-and-mortar retail. Problem number 5. Cathie counts deferred income as though it were actual income. With her accounting method, Cathie wants to count deferred income immediately. Deferred income is money that arrives before the service or product is delivered. Or it's money that arrives, but there are claims against that money later. Let's take Roblox as an example. For those of you who don't know what Roblox is, Roblox enables people to use its game engine and tools to create online video games that anyone can play. Sort of like YouTube for games. Roblox makes money by selling tokens to gamers called Robux, which users use to play the games. Cathie wants to count all this money that arrives at Roblox as income, but there are claims against this money. Roblox must pay 25% to game creators. In addition, seller affiliates receive 40% of the money, while Roblox gets just 30% of the money. In addition, Roblox is an app that's sold by the Apple and Google app stores. Roblox has to pay a 30% commission to Apple and Google when its app is sold on the Apple or Google platforms. But Cathie wants to count all this as income to Roblox before all these creator and sales commission costs are deducted, costs that eat up 52 to 60% of Roblox's income. In addition, users who buy Robux can keep their Robux indefinitely, and people often keep their Robux for months, even years. By counting all deferred income as actual income, without also pulling costs of generating this income into the same quarter, this can produce a very distorted picture of how the company is doing. By Cathie's accounting method for this trailing 12-month period that she's talking about here, ending in Q2 of 2022, Roblox goes from an approximately $600 million loss using GAAP-based EBITDA accounting to a $600 million profit using Cathie Wood's accounting method. That's how misleading this is. And actually, a quick check of Roblox's financials shows a loss of $924 million for 2022 if we just use generally accepted accounting principles without EBITDA, which is how Warren Buffett would look at this. And this truth is reflected in Roblox's stock performance, down 36% over the last 5 years and down 67% since its price peak in November of 2021. And Roblox is among the better performing stocks in Cathie's portfolio. And here's one of the funnier charts that Cathie presents in her article, her cash burn chart for the 72% of companies in her portfolio that are losing money. So this is the cash companies have raised from investors and their public stock offerings. This is a chart that estimates when these companies will burn through the cash at their current rate of loss. Some down here have 1, 2, or 3 years left to survive if they don't start turning a profit real quick. An Invitae down here has already declared Chapter 11 bankruptcy. Its stock is selling for less than a penny. Cathie presents this chart as good news, as optimistic. She says in an article here that if needed, these companies can extend their lifespans by cutting back discretionary research and development spending and spending on sales and marketing in order to extend their lives. Or if needed, they could raise more capital. But of course, that would require issuing more stock, which would dilute the value of the current stock investors are holding. And there's certainly no guarantee that there will be buyers of this newly issued stock if the company is teetering on the brink of bankruptcy. I'm not interested in investing in companies that are burning through cash and that are counting the days until they go out of business. I want to invest in growing, profitable companies with proven track records of success that are throwing off boatloads of cash so they can expand into growing markets like NVIDIA, or more broadly the SOX index of the 32 biggest semiconductor companies. Also the QQQ and the S&P 500 index fund like SPY. Maybe throw in a little Bitcoin, 10% or so, which doesn't throw off cash, but is a scarce, finite asset, something like gold, digital gold, plus with real estate as an anchor for stability. That's my approach, heavy diversification with growth, with emphasis on leaders, proven winners in expanding markets. No matter how you look at it, Cathie Wood's investing approach has been a total disaster for her investors, but not a disaster for her. Again, she's piled up an estimated net worth of $250 million via the money management fees that she charges her investors. This is how you fail your way to success, and it's very common in this world. Do not have any faith at all that these money managers have any clue what they're talking about. So what's the lesson here? Well, I think there are two. Number one, in the end, it really is the responsibility of each individual investor to understand what you are investing in, which includes the risks. Number two, it's possible to be spectacularly successful in life, even if you really aren't any good at what you purport to be good at. This is called fake it until you make it. And Cathie's done this to a spectacular degree. And she was able to do this because she was able to string together a pretty good narrative that sounded plausible to folks who knew very little about investing, very little about how to read an income statement or a balance sheet or evaluate risk or understand even the most basic principles of sound investing. Now, in many ways, I admire Cathie Wood. All successful people fake it until we make it to some degree. That's how we learn. That's how we get better. We learn by doing and by failing. I launched an ad agency in 1991 when I knew almost nothing about advertising. But I learned about it, learned as I went, and I partnered with someone who knew more about parts of the business that I knew nothing about. And over time, I learned the business. My advertising and marketing campaigns have generated more than $1 billion for my clients over the decades. You learn by doing, you learn by faking it until you make it. When you're first starting out and you're trying to find clients, you pretend that you know what you're doing when you don't really know that much. In the land of the blind, the one-eyed man is king, right? Or queen, in Cathie's case. She pretended she knew something about stock picking. Now she's worth $250 million. That's talent. She's no good at all at securities analysis. No good at all. She would do well to read Benjamin Graham's classic books, Security Analysis and The Intelligent Investor. These were Warren Buffett's Bibles. Warren Buffett, of course, being the most successful investor of all time. And Warren Buffett was a student of Benjamin Graham at Columbia University. But actually, Cathie doesn't really need to read these books at all because she's so good at sales. And she's worth $250 million. So there's really no reason for her to learn anything about stock analysis. I mean, how can she still have $14 billion under management with her track record? But she has her faithful believers. She's like the Pied Piper for these folks, just leading them to the slaughter. I need to include Cathie Wood's story in an updated edition of my book, Win Life, Success Skills Schools Don't Teach, because she is just such a great example of fake it until you make it. It's available on Amazon in all the formats. This book is aimed mainly at young people, age 30 and under, but this book should help anyone who wants to get in the top 1% in terms of income. Or maybe you just want to lose 20 pounds. This book will help you do that too. This book will help you achieve most of what you set out to achieve, whatever goal you might have in mind. So check it out, and see you next time.